Welcome to Trading Pro. In the previous video, we became acquainted with the concept of complex pullback patterns. Next, we will learn how to trade various complex pullback patterns. Preparing this portion of the video is quite a challenge for me. Explaining technical analysis is straightforward, but teaching how to trade these patterns from an operational standpoint and making sure that the majority can comprehend it is more difficult than one might think. Let's start with an example of a wedge pullback and discuss the problems you may encounter in actual trading. Please note, in actual trading, we rarely encounter such a standard wedge. Most wedges are composed of 3 pushes. As long as these 3 pushes form something similar to a wedge, we trade it as a wedge. Firstly, let me remind you of a phrase I often repeat. When one pattern fails, a new pattern structure immediately forms. Until the market trend is complete, we don't know what structure the market is forming. How do we understand the statement? Look at the wedge pullback in the chart. The market has already formed the pattern. From a post-event analysis perspective, this wedge is very clear, and its entry point is very specific. However, if we remove the subsequent candlestick, the market becomes unclear. We don't know if the next thing it will form is a wedge. Let's start by interpreting the current market state, beginning with a look at the larger market context. Right now, the larger time frame is still in a bullish trend. It started with a rapid movement, followed by a narrow channel, and then a wide channel. This is a sign of a weakening trend momentum, which could lead to a deep pullback. Indeed, a deep pullback appears here. But the larger bullish trend hasn't changed. Now, the price is approaching a horizontal support level. Here, our trading logic should lean towards going long. Let's now look at the detailed trend in the smaller time frame. We can see a rapid price drop with a very large decline, almost reaching the previous horizontal support level. Then there's a noticeable rebound which can be understood as a pullback in the downtrend. After the pullback trend ends, another rapid drop follows. As we've often discussed, rapid price movement can easily lead to momentum exhaustion. This is especially the case with a rapid movement, followed by a pullback and then another rapid movement. After the price break through the previous horizontal swing point, it rebounds immediately, which is a sign of exhausted downward momentum. Even though we're not looking at any indicators right now, we should know that there's a divergence happening here. This so-called indicator divergence means that the trend momentum is insufficient. We can directly see this from the candlestick chart without having to look for it in the indicators. As price action traders, this is a skill that we must develop, recognizing so-called divergences. That is, the insufficiency of trend momentum. Let's observe this. Here is the first rapid drop, and here is the second. We can clearly see that the second drop is weaker than the first. Therefore, when the second drop shows exhaustion, this is a signal of divergence. Of course, I seldom refer to it as divergence. I generally call it momentum exhaustion. In the context of a larger bullish trend, there's a rapid drop, followed by a pullback, and then another rapid drop. This second rapid drop lands right at the horizontal support level and is accompanied by divergence and momentum exhaustion. This presents a very good rationale for going long. We hypothesize here that after this 2-stage pullback, the bullish trend might have completed its consolidation pattern and will continue in the original trend direction to test the previous high. Let's observe the subsequent market trend. We'll pause here for now. We can see that the bullish momentum didn't continue. Many students may not understand what different candlestick combinations signify, so let's briefly interpret it here. When we see these 3 bullish candlesticks, we think that the downward momentum has exhausted. This judgment needs subsequent persistent bullish power to confirm our interpretation of bullish strength. However, looking at the following candlesticks, there are 3 overlapping ones. We've mentioned that overlapping candlesticks represent a trading range, indicating a market pause. Following that, the market immediately formed a long bearish candlestick with a long lower shadow, which we can interpret as a second test of the low point. In the subsequent price action, we can see many non-trending candlesticks and significant overlap. signifying that the bullish energy and strength didn't continue. As the price slowly rises when this large bearish candlestick appears, we must be cautious. For the bulls, the current market state is extremely unfavorable. This is the first stage of the rally, and this is the second. The second rally ended with this type of signal indicating weak bullish strength. If you entered a long position here, like me, as a short-term price action trader, you would need to manage your orders in real time. You might accept a minor loss and exit the position here, rather than waiting for the market to hit your stop-loss level. Let's continue. We see the market has undergone a third stage of decline, and only here do we realize it's forming a wedge pattern. We will trade based on the logic of the wedge. Previously, we analyzed that the market would undergo a two-stage pullback. Was there anything wrong with this logic? Not at all. You could revisit our analysis. Based on the market condition at the time, it was the most reasonable prediction. It just happened to be negated by the market, which happens often in trading. If we knew in advance that it would form a wedge-shaped adjustment, would I have gone long during the previous two-stage pullback? Certainly not. But I can't possibly know in advance that the market will form a wedge. Only after the logic of the two-stage pullback has been negated by the market, for example, after the emergence of the bearish candlestick I just mentioned, do we realize that the market might form a wedge next. If the market had consolidated after the two-stage pullback and then directly risen, there would be no wedge. If the wedge continues to decline, seeking a lower position, wouldn't the wedge have failed? This is also possible. We cannot control or predict the market. Therefore, if I directly presented a completed wedge pattern for analysis, it might not have a great educational effect. I hope that by the end of studying with me, you can master your own trading techniques, not just post-mortem analysis. Secondly, for traders of different styles, they interpret the logic of a pattern differently. For instance, traders like me, who are always in the market and continuously monitor price action, will trade whatever pattern appears. So, when the three-stage bull flag fails, I might consider shorting. Here, a simple bear flag adjustment, I might also participate. When I notice that the second stage of decline has exhausted its momentum and confirmed the support level, I'd go long again, treating it as a two-stage pullback. If I subsequently notice that the bullish strength is not followed up and a third stage decline appears, I'd treat it as a wedge and trade accordingly. If you want to operate like this, you need a deep understanding of price action and sufficient trading experience. Half-baked trading skills will only lead to repeated mistakes in the rapidly changing market, accelerating the speed of margin call. But suppose you only trade completed patterns like the market has already formed the wedge, and then you decide to enter the trade, ignoring previous fluctuations. This style of trading is simpler, and you don't have to care whether the two-stage pullback was successful or not. If it was successful and the price directly rose, you wouldn't bother. If the two-stage pullback failed and went into the third stage, you'd trade the wedge. You'd wait until the market has clearly formed the pattern you want to trade. This style is more suitable for beginners. Let's now talk about how to trade this wedge pattern. There are conservative and aggressive entry methods. If you are an aggressive trader, you can place an order at the channel line. This is left-sided trading. If the wedge is ultimately formed, entering at the channel line will give you an excellent risk-reward ratio. We can see that if you want to trade the wedge, your first target should at least be the swing point, and you can set your stop loss a little below. This gives you an excellent risk-reward ratio. However, placing an order at the channel line reduces your success rate, as the pattern is only confirmed when the wedge successfully breaks out. You don't know whether the wedge will slope upwards after your entry. How do we place an order at the channel line? For example, when the price reaches here, you should connect the two swing lows. I also suggest you pay more attention to these channel lines in your trades. Observing how the price behaves after touching the channel line can greatly assist your trading and chart reading. When the price reaches here, if you want to trade the wedge, you should have already drawn this channel line. I suggest when drawing the channel line, you can simply connect the extremes of your candlesticks. We know that there are often multiple interpretations when drawing lines. For example, these 2 points, I can connect the body parts, like this line here, or I can connect the extreme shadows, which is also a line. Why do I suggest you connect the extreme parts? Because your left-sided entry is already very aggressive. It's best to enter at the most conservative point. For example, if you connect it with the body, then you would have entered here. In this case, you lose the advantage of left-sided trading. Your advantage is a very high risk-reward ratio. Some people may ask, what if he doesn't give me an entry opportunity? If there's no opportunity, then don't enter. Since you have chosen left-sided entry, I suggest that it's best to do so at the most conservative position. This way, even if your win rate decreases, your trading will still have an advantage in the long run due to a high risk-reward ratio. You may also choose to enter upon breaking the upward trend line, but this is not my preferred entry method. I can point out a few reasons. First, you can't find the accurate trend line. The wedge I've chosen now is a very standard one, but the market doesn't always provide such standard patterns. You can't determine which trend line is truly valid and which is truly broken. This is the first point. You can't find the precise breakout point. Second, false breakouts can easily occur. For example, here this line is already fixed. If you directly enter upon breaking this line, and if it's a false breakout, it will immediately trap you. Let's continue with this example. We see that it broke out here. If you entered, where would you set your stop loss? We see that this is a rather rapid rise with no price consolidation area in front and far from the swing point. Our stop loss setting logic generally follows 2 points. One is having a price consolidation area in front. Second is setting it at the previous swing point, just like this. If you enter upon breaking out here, your stop loss needs to be set this far, greatly reducing your risk-reward ratio, losing the advantage of trading this pattern. There's another stop loss setting method used by experienced traders. For example, they enter upon the breakout of this candlestick. Then they set the stop loss below this candlestick. They believe that if this candlestick is broken, then this breakout has failed. But let's think about it. Even if this breakout fails, does it mean that this wedge pattern has failed? This wedge might adjust for a while and then continue to rise. So when you tighten your stop loss to improve your risk-reward ratio, you decrease your win rate. When you widen your stop loss to increase your win rate, your risk-reward ratio decreases. You can't simultaneously increase your risk-reward ratio and your win rate. For those who choose to enter upon breaking such a trend line, I have 2 suggestions. The first is to better not enter upon breaking the trend line, but upon breaking the previous swing point, because the support and resistance effect of horizontal levels is always better than that of diagonal lines. The second suggestion is that you could choose a pattern of breakout pullback second breakout. For example, here it breaks out upward, and then the price undergoes a brief horizontal movement, or a minor pullback over 1 or 2 candlesticks. When the price breaks the high of this candlestick again, you enter. After the price breaks out and briefly pulls back, it continues in the original breakout direction, which increases the success rate of the breakout, and your stop loss will be set below the small pullback swing point. In this case, your risk-reward ratio is also quite suitable. If you are a conservative trader, you can wait to enter after a successful breakout and pullback. This is right-sided entry. Once the wedge is confirmed to have broken out, your success rate increases. But at this point, you may lose the risk-reward ratio. You don't have as high a risk-reward ratio as those who entered here. Sometimes he won't give you this pullback trading opportunity, and this is inevitable. With right-sided entry, conservative entry, you improve your trading success rate and you also get a decent risk-reward ratio. If you enter during the pullback, it's certainly better than those who enter upon breakout. You get a decent win rate and a decent risk-reward ratio, but your trading opportunities definitely decrease. This is inevitable. This is the trade-off you face in actual trading. That's for today's video. And if you like this content, please like, comment, and subscribe so you won't miss out. And I'll see you in the next video.